Mode.
Hi, this is Sandy Vicani. Thank you so much for attending our webinar on private financing. Just a great opportunity for you and your clients. Uh, to get into this market. We have Kip Walker with Mutual Trust Life. He will be presenting. Before I send it over to him, just a couple things that I would like to go over. Just again, wanted to welcome you to Insurance Agency Marketing Services and our webinar. We have a full house today. Any questions that you have, please make sure you write them down, and Kip will be more than happy to get those answered. A couple things that here at Insurance Agency Marketing that we are offering currently. We have something coming up called a Caddies and Casinos. And what that is if you produce with Athene in place annuity production of $1,250,000 for you, or 1.75 for you and a guest, you will be going to a great place called Caddies and Casinos. It's the Four Seasons at Mandalay Bay. It's first-rate gaming, golf, entertainment, absolute great opportunity for you to get out there. All of that production also qualifies you for, our big trip as well, which is the Fairmont Empress in Victoria, British Columbia in 2016. That qualification period started January of last year, goes all the way to June 30th of this year, and that is $2 million of annuity premium, 1.5 of single premium life, under 75,000 of life target premium, which would be great with this private financing, $1 million of Medicare sup premium, or 400,000 in long-term care. So that Caddies and Casinos, all of that premium would count for that in addition to this Fairmont Empress trip. What we have to offer as well here at IAMS is it's called the Life and Annuity Academy. We have 3 of these a year. These are industry recognized. We have a lot of demand for these. Our last academy, we had over 1,000 registrants. We choose between 35 and 40. We have one coming up, just this week actually, where we had over 400 register. And what it is, and we again take between 35 and 40 agents, it's a 2-day training, all expense paid. It goes over indexed annuities and the annuity trends. We go over client objections and their risks and needs analysis. Go over every type of income rider that would be on an annuity and how it can affect your annuities and your clients. We do profiling of clients. We overcome the client objections. We go over wealth transfer, which is a great annuity alternative. Sales ideas and strategies. We go over seminar selling systems. It truly is an industry recognized academy. We hold 3 of them. We have, if you would like to get registered for that, I am putting up a poll question now. Please answer, just check off yes. We'll get you some more information in regards to when our next academy is. Such great information. Top producers attend and truly goes over about anything and everything you can think of that would affect your business, whether it's upcoming laws that are changing or upcoming rates. And how that impacts the insurance industry. So I will leave that open for just a few more moments before we go on to the next. Great. What we also offer here is a new producer bonus. So if you're brand new to IAMS, never produced with us and get contracted with us, let's say for Mutual Trust Life, you would, and start writing and placing business, you are eligible your first 6 months for a new producer bonus. It starts at $100,000 of placed business. You can earn a $750 cash bonus all the way up to a Ritz-Carlton Travel Rewards personal getaway. So for, for 100,000, whether that's life or annuity business placed, you can get that bonus. You can choose a 2-year subscription to a website and newsletter service, or you can do a latest iPad generation. If you get to that $300,000 level, you get a $1,500 gift card, or you can choose a full Social Security program with a 3,000-piece postcard mailing, or your choice would be a $2,000 matching marketing money to promote your business. If you hit that $500,000 level in that 6 months, you get that great Ritz-Carlton Travel Rewards make your own personal getaway. And again, all of this premium that you're doing for this new producer bonus is counting toward all of those trips that I had previously mentioned. If you're not wanting that Ritz-Carlton Rewards getaway, you can get a 5,000-piece mailing and seminar coaching with Matt Gill, or you can get a 4,000-piece mailing and seminar coaching with Dave Pemper. So great incentives for any new producers to come on here with IAMS. For any agents of ours that are currently with us or are currently interested in getting contracted with us and get contracted with us, we have a referred producer program. You get, when you refer an agent to us, you get $50 once that agent signs a contract. You get an additional $100 when your referral starts submitting business, and then you get paid 0.20% on any business that is placed from thereafter that your referral writes. It's endless. So as long as that referral continues to write and place business, you'll continue to receive that 2.20 bips in referral bonus money. So it's a great opportunity for you just to give us a name or have an agent that you know give us a call and say, hey, John Smith referred me over to you, and let us do what we know how to do best, which is get the agents on board and tell them all the great opportunities they have here at IAMS. For you as an agent, we also have marketing reimbursement. We pay $200 in marketing reimbursement money per $100,000 in premium that you place with us. And again, that's whether it's life or annuity premium. We put that money into a special account. So let's say 6 months from now, you have some business expense where you need to pay for, a website, or you did a bunch of flyers and it came to $400 and you have $200 in your account. All you do is submit that invoice and we will cut you a check for that $200. So it's a great opportunity for you to get some of that money back on your business expenses. We do offer, our creative department does such an amazing job, whether you're looking to do some brand build-up on, your logo or come up with a logo design, do some business cards, stationery, letterhead. We also assist with, print marketing as well, and that would be mail pieces, custom projects, newsletters, which is really big and popular. We are able to assist you with that. We also set up websites and monitor those websites for you. So if you don't have a website and you're thinking about wanting to do that, I suggest you contact our media team and talk with them. They do a great job with monitoring and making sure once the website is set up that everything is current and running. We also have, advanced online marketing. So with that website, we'll also provide an email newsletter service and a paid search management for your local area, along with online video ads. If you'd like to do a radio ad, we're able to help create a radio ad and do a channel deployment. Same with television. We can help with video creation and do a local channel deployment. So there's a lot of opportunity on the creative side to help your business or to help promote your business. So please let Adam Bylis or Matt Neal know in our creative department, and they will be more than happy to assist you with that. And again, we have our Fairmont Empress trip. It's our great Top Producers Escape that I mentioned earlier. It's August 3rd through the 7th of 2016, Victoria, British Columbia. Amazing opportunity, long qualification period. You still have a long time to get qualified for that, all the way till June 30th of 2016. Again, $2 million in annuity premium, 1.5 in single premium life, which is a great product, then 175,000 in target premium. So would love to see all of you there. At this point, let me go ahead and get this turned over to Kip Walker. Kip?
Yes. There we go. Okay, can you hear me okay, Sandy?
Yes.
Okay, great. Well, thank you very much. I appreciate being back with AIMS again, and appreciate hearing all of the great things that you guys do for the advisors in your membership. And this is just another example of the things you do. We're going to go through a training here on the infinite banking concept. Done this a couple times now, and I enjoy talking about the infinite banking concept because it's just a powerful strategy to help your clients make more of their money and have a more efficient way to use their money and save for their retirement or whatever other needs they are building towards or goals they're trying to achieve. Excuse me. So my name is Kip Walker. I'm the National Accounts Manager with Mutual Trust, and we're going to go through the infinite banking concept. I'm not going to make you a guru at this by any means, but we are going to give you a solid foundation and let you know where to go if you are interested in learning more about it. So here's a quote from Robert Kiyosaki that kind of sums up what we're trying to do here. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. So we're really trying to not only build wealth, but generational wealth. We're trying to help families put together something that can build over generations. And that's what the infinite banking concept really helps your clients do. So go ahead and take notes, ask any questions that you have. If a name pops into your mind that this may be a good fit for, please write it down. Even if
we may have lost Kip there for one moment, so let me get him back online. So there will be a momentary hold. One moment, please.
Sandy, can you hear me now?
Yes, I can. You're back.
Yeah, my call got dropped. I don't know what happened there.
Oh,
I just
sure.
all of a sudden it went blank.
Okay, good. I'm glad to have you back.
Okay, well, I'll go ahead and just continue here. Sorry about that.
Okay, great.
All right, so and as I was saying, take any notes that you can. Ask any questions. Many times we have designs that are, non-traditional or unusual, and we have a lot of variation in the way we can design these cases. So I urge you to, give us a call or, give Sandy a call and ask questions, or she can find out the answers for you. however you guys want to operate that. But even if you're not sure it's something that'll work, we'll tell you what we can and can't do. We're not going to try and make a square peg fit in a round hole. So let us know. We'll educate you on the program even more. That's really the best way to do it, is to go through an actual case most of the time. So go ahead and write those names down, and we'll take any questions that you have. And as Sandy mentioned, if you have anything that comes into mind during the call, go ahead and type it in to the chat area or the question section. So here's what we're going to cover. We're going to cover the concept, what the problem is, what the answers are, IBC illustrated, how it works, who your client is, and then we'll take a look at an example. So what is infinite banking? It's a sales concept, and it's based off of tax laws and the power of compounding. It involves maintaining liquidity, use, and control of your money and putting you in the most advantageous position for financing. Okay? It represents probably more than 40%, probably 50 or 60% of mutual trust business is in the infinite banking concept. We have probably about 40% of our outstanding loans in infinite banking currently at any given point. So we're really built for the infinite banking concept from top to bottom, from products to product administration, and from sales support to underwriting. So it is really an organization that is built around the use of those living benefits and the infinite banking concept. We have over 10 years of experience with infinite banking. We started it with Mark Creighton, who has been with us from the beginning, and he is the real guru in infinite banking. He and I go across the company training an infinite banking concept every few months to keep everybody up to date on the infinite banking concept and what we do and why we do it. Mark is a great resource for us, and he's done a great job building up the infinite banking space. So what is the problems? What are the problems that we're dealing with infinite banking? It's how do I keep more of what I make? Pretty basic question there. Limits of qualified plans. How do I deal with limitations on qualified plans? You know, qualified plans do two things. They delay the taxation of your money, but they also delay the tax rate that's going to be imposed. And so what we do is, with these qualified plans, and I'm not saying they're bad, they're good things, but this is just what they do. We give our money over into these accounts, and in return the government says, we're not going to take the taxes from you right now. We're going to let you wait. But when you finally go to access this money, at that point we're going to know how much money we need, and we'll determine what tax rate you're going to need to pay. Okay? So the only way you win in a qualified plan is if that tax rate that you access the money at in the future is lower than the tax rate you're paying now. Okay, so most people feel like they're going to get richer, not poorer. Also, if you take a look at which, you know, higher income will lead to a desire for a higher distribution from those qualified plans to maintain your standard of living when you finally do retire. Also, we have $19 trillion in debt, national debt. Clock just rolled over to $19 trillion about 4 or 5 days ago. It is going up at a very quick pace. We have, by some accounts, almost $200 trillion in unfunded liabilities, and an income tax rate that is on the historically low end of the average scale. So that's not even counting state taxes. So taxes are huge, and one of the big important aspects of the infinite banking concept is the tax-favored treatment of funds in whole life insurance, in cash value life insurance. So this is a big deal. It's a huge deal because we have the troublemakers being Social Security, Medicare, and Medicaid constituting the third rail of politics, and nobody wants to touch them. So, you know, it's pretty scary as far as how we're going to deal with this. But this can take some of that risk off of your client's backs and put it into something where it's shielded from those potentially much higher tax rates. But that's just one of the the limitations on the qualified plans, however, they are a great deal if things go well and taxes are the same or lower when you do retire, then they're a great way to help build your retirement for the future for sure. The other thing that infinite banking does is own the debt and grow your wealth. What we're going to do is we're going to try and recoup some of that interest that you're transferring away from yourself unknowingly and unnecessarily, and redirect that back into your savings. Okay, so we'll take a closer look at that. And then also we're going to deal with the limitations of cash. And you can talk about cash as being, CDs, savings accounts, money markets. Right now, with the interest rates being artificially lowered by the Fed, we're in a very difficult situation for savers, especially those who want to avoid any kind of risk or as much risk as possible. You have savings accounts paying 0.25%, CDs paying maybe 1.5 or 2 on a 5-year CD. So it's really difficult to get a decent yield in this environment, a yield that's going to help sustain your savings while you're also trying to live off of the interest. You can forget about that in many cases now. We're just trying to hold on to as much of our nest egg as possible in this low interest rate environment for those who are savers. Lack of safe options. Many times you'll see the markets rising in this type of low interest rate environment because people are chasing a higher yield, and that carries with it more risk. But that's what people are being forced to do when they're trying to get a decent rate of return on their savings or investment. They're chasing, maybe a little bit more riskier beauty bonds, or they're chasing stock market returns. We've had a very long run in the stock market, so that feeds into the market uncertainty that we're having right now, and where the market's going to go in the future, we can't tell. But the last 2 times we had a 7-year bull run in the market, we had a terrible downturn, and so we're in the 7th year now, past the 7th year. So there's a lot of uncertainty as to what's going to happen next in the market, stock market. Taxation we already hit on, hit that pretty heavily, so we understand that. Availability and access to capital. It's really important to maintain access to capital, and wealthy individuals understand this very well. If you have an opportunity that comes up that provides you with a really good risk-reward scenario where you can have a great rate of return for relatively low risk, if you don't have access to capital to take advantage of it, then that opportunity is gone to you. It's not available to you. So it's very important to maintain access to capital. So here's the problem. Everybody finances their major purchases, and we'll go into more detail on that in a minute. But the problem is they're financing these items at other banking organizations with limited ability to be in control of getting the best rate possible. And so that's one of the problems that we're facing. The other one is it's not just the interest rate, but it's also the volume of interest. If we take a look at this chart here, we have a car loan. That's a 6% car loan for $30,000. That provides a payment over 5 years of $595. $175 of that car loan payment every month is going to interest. So that interest is being paid and lost forever from that client. It's being paid away and lost forever. The other $419 is going to pay the principal. So that's the volume of 30%. 30% of your payment every month is going to just pay the interest on your debt. The next one is credit cards. $10,000 credit card outstanding there. I think that's about a 16% rate. You have a payment of $250. $100 of that is going to pay the interest for about 40% of every payment. Take a look at mortgages. You have a $200,000 mortgage, about a $1,200 payment. In the early years, mortgages are really designed to collect that interest up front. You have $1,000 in interest costs of your $1,200 payment, or 83% of your payment is going towards interest. And I know a lot of mortgagees out there, they'll say, well, when I get up to 25 years, it'll be mostly principal at that point I'll be paying. The thing is, how many people do you know actually get to that 25-year mark we generally, what have we been doing? I mean, especially in this decreasing interest rate environment that we've been in prior to this recent crash in 2008 and 9. It was a decreasing interest rate environment, and everybody was refinancing over and over again. And so many people will never really make it to that 25-year mark. Very few do. So we're always resetting that amortization schedule and making it so much of our payment is going to interest that it's really just transferring away wealth from us that's just not necessary. All right. So here's what I mentioned earlier. We finance all of our major purchases. The issue is we're either paying interest to lead to finance, or we're losing interest that we could have earned if our money had stayed in our savings account or whatever vehicle we're using. So here's an example. If you have a loan that's amortized over 5 years, and the interest rate the bank is charging you is 5%. If you amortize that loan over 5 years at 5%, you're going to pay a certain amount of money in interest charges and finance charges. Let's take the other option now. Let's say you have a savings account, and you've saved up the money that you need to make the purchase that you want to make. And in that savings account, let's say you're getting really, really lucky and you're making 5% annually. And you've determined that instead of doing the traditional financing option, we'll call this person A, taking a loan from a bank over 5 years at 5%, person B is going to take the money out of their savings account that they've been saving up for a long time, and they're going to just pay cash and then pay themselves back into their savings account. Now, the interesting thing is, if they do that, they are bringing their cash savings, let's say that's all the money they have, they're bringing their cash savings down to zero, all right, and paying it back up over 5 years. The cost between those two individuals, assuming they pay at the same period of time over 5 years, and one is financing for 5% and one is losing out on a savings rate of 5%, the cost to those two individuals is exactly the same. They're both losing the exact same amount of money. They're just doing it in different ways. One is starting at the zero line, person A, is starting at the zero line and then trying to work his way back up to zero. The other person, person B, is draining their account down to zero and then trying to build back up to where they were before. So the cost is the same. They've both lost a lot of control over their bargaining power and the assets that they have access to. And they, neither one are going to be able to take advantage of the compounding that occurs when you leave your money in a stakes account to just let it grow. Because person B has drained that account. Person A never had it to begin with. They took a loan. Person B hadn't had the money. It's growing at 5%. And now they're thinking, well, that's okay. I'll just pay myself back at 5% and I'll be good. Some people might do that. They might take out that money and pay it back and put in the 5%. But nobody that I know has ever taken the money out, paid back the 5%, and then the 5% on top of the 5% they earned. In other words, the compounding is lost to them. So they're just resetting the clock and having to save back up again. So this is another issue where it becomes very difficult once you take yourself off that compounding curve to try to get back on it again, get back on track. And so we're always trying to play catch up. Einstein said that the eighth wonder of the world is compounding. So if we know that compounding is the eighth wonder of the world, at least according to Einstein, and I agree with him, then how often do we want to take ourselves off of that compounding curve? The answer is never. We never want to take ourselves off that compounding curve if we can help it. So that's something that infinite banking helps you address. All right, so the answer, IBC. Here are the features of an infinite banking concept. Guarantees. There's guarantees and then there's guarantees. And you have a guaranteed rate of return that can be that is offered, and we have that. It's 4% in the product that we use, which is the Covenant 2, which is really built for infinite banking. But equally important are the guarantees and the expenses and mortality costs, because guaranteed interest rates are only half of the equation, and many times what you'll hear in the industry is a gross guaranteed rate quoted to you, and that's fine, but it doesn't tell the whole story, because if you're not locking in those expenses on the other side, your clients are going to be getting a statement that shows at the bottom that their cost of insurance has increased. And yes, they did not lose any money due to a downturn in the market, but on the other hand, their investment didn't earn enough money to cover the increase in the expenses that they'd incurred. So the cash value did in fact go down on their account. So, when you're dealing with infinite banking, it's very important to know what money is going to be in your account or in your policy at that point. And I'm not disrespecting any other types of policies like Index UL and Universal Life. These are great products. They are great for capturing upswings in the market rates of return and giving your clients potentially better cash value down the road to provide a great tax-free retirement. So that's not my intention to disparage any one product, but infinite banking needs to have a degree of certainty that can't be offered in the early years by IUL. It just isn't built for that. It's built differently, and that's why there's all these products are out there, is to address different particular needs. We're all dealing with the same, and when I say we, all carriers and all different types of life insurance, cash value life insurance products, we're all dealing in the same investments. We're doing the same thing. We're dealing with the same tight profit margins. It's just how are we arranging our risk? And with whole life, it's a different trade-off. We're decreasing the face amount a little bit. We're locking in the cost and giving you an expected cash value growth that cannot change contractually. We cannot do it. There are no escape hatches. The client pays the premium. Cash value has to be there, or we're in big trouble. So it just doesn't happen. So that's the thing with whole life, is that knowing it's going to be there. And there are many times when different policies can be used with the same family to accomplish different objectives. And so whole life could be the policy used for this concept that we're going over today. So because you have those guarantees in the policy and the cash value and the rate of return and also the expenses, there's no interruption in that compound road. It just keeps marching forward and getting stronger and stronger as time goes on. Another important thing is that in all cash value policies, the gains are tax deferred, and as long as it stays a non-modified endowment contract, those gains can be accessed tax-free if done properly. So this is very important. I mean, we just hit on taxes and discussed those and went through them in detail of the risk that we are facing as a country here. Taxes are a very big deal, and the tax treatment of life insurance is a huge benefit. You also have liquidity, access, and control. It's very important, as I mentioned at the beginning, if an opportunity comes along to get a better rate of return, or just take out a loan to make these purchases, make large purchases, you need to know that you have access to those funds. Let's say you are paying down your home mortgage really quickly because you want to be out of debt from your home mortgage, which is fine. But let's say you put so much money into it, something comes up now, and you need access to the funds that you have used to put in to pay off your mortgage as quick as you possibly could. And so now you've got to go into the bank and say, I have this house, it's paid off, but I need to access the equity in the home that I have built up. And is that a guarantee that they're going to get those funds? The answer is no. I mean, the housing market could have crashed again. They could have lost their job, or their income could be very erratic. The bank is going to look at all of these things, and there is no guarantee that they're going to be able to access liquidity in their home. But if you put your money into a cash value life insurance, it's in the contract. The loan is a guaranteed contractual right to the client, and they can fill out just one piece of paper and fax it over to the life insurance carrier, and money comes it comes to you. There's no request made. It's a demand because it has to be done. All right. So liquidity, access, and control is very important. Immediate tax-free death benefit. So not only does the tax treatment have a huge impact on your ability to save more and recoup or redirect those tax dollars that would have been paid away from you in the form of a 1099 if you leave it in a CD, or at the end of the annuity period, if you start taking distributions from an annuity, you're going to get hit with taxes at that point. But you also have an income tax-free death benefit to your heirs that is payable immediately. So in case something terrible happens and you don't make it to the next year, you know that what you want to happen will happen, which is an income tax-free death benefit to your heirs, to your loved ones, or to your charity that's very important to you. So you're starting out on this journey to build up this nest egg, but if something happens, your heirs are still going to get the benefit of that nest egg because of that income tax-free death benefit. Here's a couple of additional points to remember. There's no fees, no red tape. So this isn't something you have to pay a fee to set up. Once it's set up, you just go ahead and keep paying the premium, and you get all the benefits. There's no red tape. There's no government involvement here. This isn't any kind of government 401k program or anything like that. It's just a contractual arrangement between the client and the life insurance company, which is also a financial institution. Quick access. You have access to, or a client has access to the cash value in their life insurance policy within 10 days. And that's really just a number to hold the place there, because they have access to the money as soon as the funds are in the policy. If they send us a check, we're going to process that check. It takes about 2 days. We're going to send it to the bank. They'll process it in about 2 to 3 days, and then the funds will show up in the policy in day 5, 6, or 7. So whenever the funds are there, that is when the client can use it to take a loan. And mutual trust does not charge any kind of chargeback against the advisor for loans taken in the first year, as some carriers do. So the client can take loans as soon as the money's in there with no implications against to them or the advisor. Okay, so here are some of the answers that we talked about in a little more detail here, and then we'll go through how we kind of set this infinite banking policy up. Liquidity, early guarantees, cash value readily available. So Covenant 2 is our flagship product, Mutual Trust flagship product, and it's probably responsible for 60% of Mutual Trust business. And when we say early guarantees, what we mean is the cash value is designed to build in the early years and be extremely competitive. And I haven't seen it being beat by any carriers in the first 10 years. And because we focus very heavily on that. Individuals who are using the infinite banking concept or the living benefits in general, they want to see that cash value in the policy as soon as possible. And so we designed the policy to do that. There's a few different ways that we do that. I'll give you one example. In the first couple of years, we actually have negative expenses in our policies, meaning the government says we can only have so much cash value in the front door for a given death benefit without creating a modified endowment contract. And when I say a modified endowment contract, that's a contract that loses its special tax treatment. And it's still treated well. I mean, you get treated like a 401k plan, basically, if you're a MEC. But the non-MECs, they have that really special tax treatment where you don't get the taxes hit on the money if you take it out, if you withdraw it, especially the cost basis, and then you can take loans against the gain and not have taxes again there. So really good tax treatment in a non-MEC. But what we do is the government says you can only have so much money going into the front of the policy, front door, without creating a MEC. And so what we can do, though, is we can have negative expenses, meaning we can put more money into the policy to cover expenses than are actually due for expenses. And that actually pumps up the cash value through the back door. So that's one example. The other example is the variability, the flexibility in our paid-up additions rider. And for those of you who aren't familiar with whole life, paid-up additions riders were created when really nobody was looking. They're the answer to the cash account in a UL. But what we did was we made it so that the face amount fluctuated to maintain all the guarantees that whole life is known for. So when you think of a paid-up additions rider, you can think of it as a single paid-up whole life insurance contract. But with paid-up additions riders, they are very easy to put money into and take money out of. So we made them very liquid, and then the face amount just rises and falls with the cash as it goes in, okay, to cover our expenses. So maintaining a face amount, the cash value guarantees, and varying the face amount to accommodate any variation for withdrawals or anything like that. So there are a lot of companies that have these paid-up additions riders, whole life companies, but they don't have the flexibility that we have. We've looked into this. There are some that will say, okay, we'll let you put premium into your paid-up additions rider, but you can only put in maybe 3 times as much as you're putting in your base premium. So these paid-up additions riders are really very important for building strong cash value, and so that really puts a cap on how much cash value you can build into these policies. Some other carriers will say, okay, you can have the paid-up additions rider for as much as you want, up to a certain, hard cap or hard limit for premium, but if you don't use 75% of that premium or pay 75% of that premium at least every 3 years, we're going to reduce the amount you're eligible to pay into the premium. Some will say, we'll let you pay it for 5 years, PUA, paid-up additions rider premium, but after year 7, we're going to cause you to have to be underwritten again. And if you get sick or something in the meantime, within those first 7 years, and when we underwrite you, you're not in good health, we're not going to let you contribute to the paid-up additions rider anymore. All right, so there's lots of restrictions that carriers put on these, and Mutual Trust has very minimal restrictions. All you have to do, you get underwritten up front, just one time up front. We'll determine how much financially and health-wise the client can qualify for, from a minimum of $100 a year up to $100,000 a year. All right, and they can pay that anywhere in between $100,000 and $100,000 every year up to age 75. No requirements for minimum funding beyond that $100 is required, and they don't have to be underwritten again down the road. It's just one time underwritten up front, and then they can vary that premium all the way down. So they pay the base premium, that'll be due, and then on top of that, you have the PUA rider that they're using to help build up the cash value even faster. With all of that variation, in case something happens, they have seasonal income or just uneven cash flows, they can vary the premium going to that paid-up additions rider to build their bank without having to lose the ability to build their bank. So just put it on pause or just decrease what they put in 1 month versus the next, what have you. So a lot of variation in the way we build these policies, and that really helps with building your own infinite bank. Policy owner determines when and how to control their policy, when to take loans. It's all up to them. So they are in control. Uninterrupted compounding, as I mentioned before, we're locking in those costs, those guaranteed costs, as well as having a guaranteed 4% interest rate. So the compounding will continue uninterrupted. All right, if they get there's no concern of a zero in the market or a negative in the market equating to a zero in growth, such as in like an IUL in the early years especially. So they know going forward what dollar amount is going to be at a minimum in their policy that they can take a loan against going forward. Okay, no red tape, as I mentioned before. So this isn't a government program; they just set it up, and there's no additional red tape to utilize the infinite bank. Here's some examples of those who have used infinite banking. It may not have been called infinite banking when they used it, but that's what they were doing. We have JCPenney, who used cash value to meet payroll at 1,400 stores back in the great crash in '29. You have Walt Disney, who took a policy loan out to create Disneyland. Ray Kroc uses cash value from his policy to loan the McDonald's chain. And then Doris Christopher borrows against her policy to start Pampered Chef in 1980. So this is just another example of the power of this program, of this system, of utilizing the cash values. And again, it's something that has been created by one government rule and the other by principle, or a function of math, I guess you would say. The first one is the tax rules. The tax treatment is fantastic and is similar, I would say, to a Roth. All right, but the problem is with a Roth is you can't use it for collateral. It's not something you can easily collateralize, if at all, and use it to finance other purchases, things like that. And even if you do, you're going to be limited as to how much you can collateralize of that Roth. So, that's one issue there. The other issue is the fact that compounding, uninterrupted compounding, the power of it, that mathematical fact that as you let money compound at a constant guaranteed rate, it becomes more and more powerful all the time and grows faster and faster. So it's really, really an important concept for long-term, slow and steady savings. Okay. So before I talk about who you can market to, let me see how much time we have here. Looks like we got 15 minutes. I'd like to try and do something for you. I want to show you how we build these policies, just real quick. And we actually have a template that's designed to produce these illustrations. We call it the insurance benefit concept for trademark and legal reasons. Insurance benefit concept still has the same initials there, IBC. Okay, and so I'm just going to go ahead and build a quick IBC case. We have a male, age 35 here, non-tobacco, standard non-tobacco. We have our IB concept template. He's paying $35,000 a year. Don't be intimidated by the numbers, by the way. This is just being optimistic, and we handle cases at many different levels. We have an average annual premium of $3,000. So, but anyway, we're just looking at a $35,000 annual premium here, and this individual is going to take out a loan in year, let's say, 6. All right, so they found a car, they want to buy it, and they're going to take a loan out in year 6. And let's say they really like the smell of fresh leather, so they're going to take a car out every 5 years, and they're going to, let's say they're going to take out a loan, and let's say when they were looking at car loans, and go with me on this for a minute, that the best rate they could get was 10% outside of their own policy. Okay, they're looking at 10%. This isn't a necessary part of IBC to still have it be a fantastic strategy, but this does add to the power of the program when we get to a more normal interest rate environment, more normalized interest rate environment. So the best rate he could have gotten was 10% outside of his own policy. All right, so he says, okay, you know what, I'm going to take the loan against my policy, and instead of paying back at the rate of 5%, which is what Mutual Trust is charging right now on loans, I'm going to pay back at the 10%. I'm going to be the wholesaler here for my own bank, and I'm going to pay the retail rate back to my policy. In effect, I'm recouping that interest that I would have lost had I not set my own bank up. I'm recouping it and redirecting it into my savings. Okay? So that's what's going on here. So I'm going to go ahead and click OK. Oh, wait a minute. I forgot to do one thing. Go back here, and we're going to set this. Here we go. All right, just got to click that one button. All right, so now there's a special infinite banking presentation, but I'm not going to go into that with you. I'm going to go into just the regular illustration, the one that the client signs. And I hit the wrong product, so I have to go back again. Hold on here. When you do things on the fly, this is what happens. All right, so here we go. We're in the right one now. And I'm going to go to the regular illustration and show you just quickly how it's built. Make that a little bigger for you. And you can see we have $35,000 going into the policy. Generally, there's about a 60-40 split between premium and PUA rider. So $14,000 is going into the base. Here's our base Covenant 2 policy. $21,000 of the premium is going into the PUA rider. All right, and then we have a little extra room, about $3,800 more a year we can put into the PUA rider if we want to. That's just the way this is designed. Remember, there are many different ways to do this. So I move forward here, And what we do is the client takes a loan against the policy. And in this case, they're just going to do it in year 11. And what happens is instead of paying at the 5% that's due on the loan, they're paying at 10%, meaning that they're recouping 5 percentage points, which is going into their policy. You can see that the premium jumps from $35,000 up to $35,638. That represents the additional interest that they would have lost had they not set up their own bank and acted as the wholesaler and paid retail rates. Okay, just a additional advantage of setting up your own bank if interest rates ever normalize. And we get into a situation which is more common, which is that the rates outside of your bank will be higher than what you are typically going to pay. And if you take a look at credit card rates now, they're still higher than what you would pay in your infinite banking concept.
Hey, Kip, we have a quick question. What's the dividend rate for the last 2 years?
Dividend rate, it varies by client, and we have 5 factors that we look at as far as face amount, age, and risk class and things like that. However, if you are looking at a dividend rate as quoted by other carriers, ours would be about 5.6%.
Okay. And then is it direct recognition on loans?
We are direct recognition on loans, but that does not mean you don't get a dividend. It's basically a factor that we use to recoup the money that those invested funds would have earned. And it's a very small amount. Right now it's 0.007. So to give you an example, let's say you had a $10,000 dividend, or let's say a $1,000 dividend, and you take out let's say take out a $1,000 loan. Keep it simple. And you don't pay any of it back, and your average loan outstanding for the year is $1,000. We're going to multiply that $1,000 times 0.007, and we're going to take off $7, or we're going to get a result of $7. That $7 would be deducted from your dividend, okay, to recoup our lost investment. So generally, it's not a big impact, and you have to look at other things aside from direct recognition versus non-direct recognition, because as I said before, the profit margins in life insurance and cash value life insurance are tight. So you have to look at the whole picture. We're not gouging on the loan interest rate, for example. We are built to maintain a profitable business model doing infinite banking, and we welcome infinite banking business. So you have to look at the whole picture when you start talking about things like direct recognition, which is generally a minor thing.
Sure. And then another question real quick. Can this be done for a child?
Yes, it can. The issue you run into with a child is sometimes you can get into situations where you can't build up the bank maybe as highly as you would like to, but it absolutely can be done. You can, as a rule of thumb, put half the face amount of life insurance that a parent has on the child. So if the least insured parent has $1 million in life insurance, you can put $500,000 on the child, and that leaves plenty of room to build a long-term infinite banking program.
Great.
All right, so just going over to finish up here. Any other questions, Sandy?
No, the other ones I've answered. It looks like one more. This page shows a non-guaranteed. Is this what is used to sell the product or the guaranteed?
I would say it depends on the client. Typically, we would use for when showing actual loans, it's going to show the non-guaranteed supplemental, because we just don't have the ability to show a guaranteed column when we're relying on them to make certain moves, like taking a loan and paying it back at a certain rate and things like that. We really can't put a guaranteed column on that. But I can assure you that what is going on is while they are taking that loan, their money is in there and it's growing. Once the loan is paid off, they are, let's see here, go back to the basic illustration. Here we go. So at the whole time that they are using the cash values in their policy, their loan is continuing to grow. And I'm not on the right page. as if the loan was not taken. So the loan has absolutely no impact on the guaranteed value. Okay, so this will happen no matter what. All right? No, there's no slowdown. That will happen in year 15, provided they've paid the premiums of $35,000 every year. For 15 years, they're going to have, you know, $37,914. If they've paid in, I'm sorry, not increase in cash value. Sorry. So over 10 years, if they've paid in $35,000 a year for 10 years, they're going to have $349,000, just about $350,000 in cash value. All right, that's exactly what the number will be. All right. There'll be variations over here on the non-guaranteed side, depending on how they pay the interest back and how large the loan is. So if they're practicing traditional infinite banking, they could actually pay themselves back at the retail rate and increase this cash value here. So those are the things we can't show when we're doing this. But so typically, yeah, I mean, generally, if you're looking at showing the infinite banking concept in action, you're going to look at that supplemental schedule. Okay. So small business, who are we marketing to with the infinite banking concept? Small business owners, doctors, dentists, chiropractors, contractors, or other professionals, clients that require regular access to capital, clients wishing to avoid the red tape associated with normal borrowing, clients seeking liquidity, use, and control of their money, looking for alternative or additional retirement options, and those with insurable interest and a desire to protect their family. So these are the individuals we're looking for here. We're not chasing rates of return. We're building a bank. We're building a pool of capital that can be accessed to take advantage of other larger, more risky opportunities under the right circumstances. All right, we're doing it in a tool or a product that provides for uninterrupted compounding, protection from creditors depending on your state. The protection varies on the cash value in case you're sued. Provides uninterrupted compounding and an additional benefits, including a death benefit that is guaranteed to happen from the moment you put the policy in place, so that if anything does happen to you, what you want to happen will happen, that you will help to build this legacy, help to make sure that your loved ones or charity is taken care of in the event of your untimely death. So a lot of powerful tool at their disposal, and many clients who even have these policies don't understand what they have and what they can do with it. So it really sets the advisor apart as somebody who is a consultant who's truly advising them as opposed to just selling them a product and walking away. You can really build a relationship here and help them figure out ways to use this pool of capital to take advantages of business opportunities or help pay for college. Many of you may not know that cash value life insurance doesn't count on the free application for federal student aid. So if you fill out this application, the application for federal student aid or aid from the colleges as well, you have to fill out this application, and when you do, certain assets count as being liquid and available to help pay for college. And the higher that number is, those available assets, the lower reward a client will get. And we're not just talking about grants and things like that. We could be talking about a better loan interest rate. We could be talking about a better offer from the college itself based on liquid assets that you have and the kind of child or the kind of academic success your child has had or sports success. So all of these things come into play, and this is just another way to put the college student and the parents in a better position in negotiating what kind of reward they're going to pay and what kind of tuition they're going to have.
So Kip, an agent wants to know, can we 1035 into this product, and are there any long-term care riders with the Covenant too?
Yes, there is, and you can 1035. You can 1035 over, and if it's a non-modified endowment contract, you could even create the infinite bank with one single payment. We could set that up for you very easily, where you 1035 in, and traditionally, when you look at a single payment contract, it's a modified endowment contract. However, with a 1035 that's a non-max, you can have a single paid-up contract and have it be a non-max. So that's a nice little benefit there. I'm sorry, what was the second question?
Are there long-term care?
Oh, yeah, sorry, long-term care. Yes, we do have a chronic illness rider that is available. It's very generous. You can get up to 24% of the face amount, up to an annual maximum of $240,000, with a lifetime cap of $1 million. Okay, and there's no cost for that rider. There's an actuarial adjustment done on the back end on the death benefit if the rider is utilized. The only thing you need to qualify for the rider is to be certified by their physician, the client's own physician, as being unable to do 2 of the activities of daily living, or mental incapacity, or mental incapacity to the point where you're unable to take care of yourself.
So a client can stop making premiums and just have a paid-up policy, correct, and have this continue to work within reason?
Yes, absolutely. We can set it up. I mean, there's things that are going to come into play on designing something like that, but absolutely. We have such flexibility built into this concept with the paid-up additions rider and the cash value growth that we can have a 2-payment non-modified endowment contract set up for many clients. And it's, again, subject to the amount that they're putting in for premium and their health risk and things like that. But generally speaking, we can have a very strong cash value growth policy with 2 payments as a non-modified endowment contract.
So
there's a lot of variation.
I'm sorry, go on.
No, that was it. There's just a lot of variation in how we can design these.
So how does this compare to an IRA, or how would you compare it to an IRA?
With an IRA, there's 2 kinds of IRAs. We're talking about a traditional IRA. What you're doing there is you are putting money into a government program, basically, where what they're saying is you put the money in to the IRA, you invest it within that IRA, and you can do a lot of different things within an IRA. You have to go through some procedural stuff with some types of investments like real estate, and there's a lot of restrictions on things like that. But just talking about traditional IRA, you can put it into a money market, you can put it into a stock market, you put it into bonds, lots of different investments. And what the government says is, okay, we're not going to tax you on that money right now that you put into the IRA. We're going to wait. We're not going to tax you at all. The money grows tax deferred, which is nice. So all your money's working for you. And then at the end of your working years, traditionally you start to access that money. And as long as you're over age 59 and a half, you'll be able to access that money at whatever your current income tax rate is at that point in retirement. If you're under age 59 and a half and you try to access that money, the government is going to say, okay, you've taken out from your IRA, we're going to hit you with a 10% penalty because you took it out before age 59 and a half. And plus, now you have to pay your income tax, whatever your maximum income tax rate is on that money. All right? So that's how an IRA works. It's just investing within a government program. But the thing is, we don't know what the tax rate's going to be. We don't know if the tax rate's going to be higher than we're paying now or lower than we're paying now. And the only way you really win with an IRA is if your tax rate is lower in retirement, because the government's along for the ride. As your nest egg grows, the government gets, let's say your tax rate's 30%. As your nest egg grows, the government is along for the ride to the tune of 30%. So it's not that the government isn't going to get that money. They're going to get it. It's just they're going to get it later, and they're going to tell you how much they want to take of it. Okay, does that help?
Yeah, so it's just much better to do this private banking now, so you have the money there. So just
yeah, I mean, it's going to depend on the client. I mean, these products all exist for a reason. I mean, you have some clients that they just are scraping to get coverage, and face amount is going to be key. And so if they get the coverage that they need, as far as maybe term coverage for 20 years to cover them for the next 20 years while they work, and all they can afford is that term insurance, they need to get the term insurance.
Sure.
But if you have somebody who wants to start building this bank and have more negotiating power and build up this program for themselves and something that they can pass on to their next generation and their children, and this is definitely a great tool to use. And it doesn't have to be the only tool. Like I said, there are Roth IRAs where you pay the taxes now. When you put that money into a Roth IRA, you pay the tax now, and then it doesn't matter what the government does to our taxes. So that's a great program. The problem is with that, at higher income levels, it gets phased out, and there's also limits as to how much you can put into it, and then also you can't collateralize it. So you can't really use that as a pool of capital to take advantage of other opportunities. So while the Roth has its advantages, it does have its limitations that can't be addressed in the way that the infinite banking concept can address them.
So right now, before you finish up, Kip, I'm going to launch the contracting poll for anyone to, get contracted with Mutual Trust Life. Great carrier, so I'm going to keep quiet while you finish up on that.
Okay, so we'll just wrap up here. I just one quick example of a case that we did not too long ago. It was a dentist. He was the son of his father, who was a dentist, and he himself was going to take over his father's practice. So he knew that he was going to have some upgrading that needed to be done to the business. His dad hadn't upgraded it in quite some time, so the equipment was old. Also, he was facing some issues with the reduction in business due to the economy, the poor economy. Many clients that had been with them for a long time were not getting the procedures that they needed. And as a result, the business was down. But also equally concerning to the dentist was his clients weren't getting the care that they needed. So, a cavity turns into a root canal if you let those things go. So this was a couple of the issues he was dealing with. So what the dentist decided to do was go ahead and finance the treatments for some of his clients. He had access to a finance company for dental treatments, but they were going to charge a higher rate of interest, let's say 14%. This dentist knew his clients very well, and he got with a lawyer, and they drew up contracts to make loans to the clients and to the patients, and determined that he could do it at about 10%. So he started doing this, and he was able to utilize the capital that he had available to him. He was going to utilize capital that he had available to them to make these loans. He had saved up about $150,000 that he had available to him. So we started talking to him about the infinite banking concept, and see if that could maybe help him accomplish what he was going to try to do here. Of course, the advantage of financing his own patients was that he was going to have more appointments, and but what he could do by utilizing his own bank instead of taking out the money from his savings account and loaning it out to his patients at 10%, and then having them pay him back, what he could do is he could take a loan against his policy. Once we set him up in his bank, he could take a loan against the policy, loan the money out at 10%, repay that loan back at the 5% that we charge, and redirect that interest at 10% back into his account, into his policy, growing his bank. And he never took himself off that compounding curve. So he's getting that continuous compound growth since he collateralized the money. And that's an important thing to remember, is that when you take a loan from a life insurance company, you're not taking out your own money. You are collateralizing the cash value in your policy. That's why it continues to grow. And so he collateralized his policy, not interrupting the compounding. He's not getting 1099 on the savings interest that he's earning in his savings account. He's not losing out on the interest that he would have that he was earning in that savings account because the money wasn't in the account; it was being loaned out to somebody else. So he just continued to compound his growth, and was able to get more patients in the seats. So, what's the rate of return on something like that? It's quite high, because you are able to take advantage of the money while still having it grow and work for you. Okay. What they did was, when they designed the policy, by the way, is the was able to put in a payment of $50,000 in year one, and $50,000 in year two, and then make much lower payments going forward. And then he could stop payments whenever he wanted. But that allowed him to fund the policy very quickly and use that heavy cash value to make those upgrades that he needed to make. And again, he was able to take a loan against his policy. He's got the best rate possible. He was looking at a business loan, you're probably looking at 8 or 9% on a business loan, but he's able to get his loan at 5%. So again, he could recoup that additional 3, 4, 5 percentage points, put it back into his own bank, and build it up for future needs, including retirement supplement. So that completes that presentation, and I know I threw a lot at you, so if you have any questions, please give us a call, shoot us an email, and Sandy, I know you can help us with any, anybody who needs assistance, just let me know. There's my contact number there, 800-323-7320. My extension is 5594. My email address is walkerk, WALKERK, @mutualtrust.com. So look forward to hearing from any and all of you.
And this webinar will be recorded, so everyone who has registered will be receiving a recorded link to this webinar, so you will have that. We have a lot of agents wanting contracting KIP, which is great for Mutual Trust Life. And again, any questions, either give Insurance Agency Marketing a call at 800-255-5055. You can ask for myself, Sandy, or anyone in the Life Department, or give KIP a call. Either one will. We'll be more than happy to assist you. Thank you so much for spending your time with us. So greatly appreciate it. Kip, thank you so much. Just such an amazing presentation that you did. And everyone, you just have a great week. Thank you again.
Thank you very much. Thanks, everybody.